want to hand to you, Anthony. As always, I look forward to finding out what's going in the global market. Sorry for a little bit of a long intro, but I wanted to celebrate with people that have achieved milestones in the last month. And welcome to the new members as well. It's wonderful to have you guys, and I look forward to you enjoying your first session.
Thanks, Scott. Morning, guys. Before I start, firstly, just Cynthia, that's absolutely great news. I'm glad we could be involved in that and help you out there. That's really nice to see feedback like that. So thank you.
And please, and I think Anthony, I echo you, but any wins like that, it's wonderful to hear it. So Cynthia, I really appreciate you sharing it. It's always good to hear people making progress and winning. It's wonderful.
Yeah, agreed. Alrighty, I'm going to share my screen quick. We can get stuck in. Can you guys see that? Is that all good?
Yes. If you just want to put it into
Cool.
PowerPoint mode, it's into slide mode.
Yeah, sure. There we go. All right, in my usual fashion, I'll just start with the indices, just so we can get a kind of bit of perspective and understand what happened throughout the month of July. Again, another strong month for developed markets as well as emerging markets. We can see here the kind of key driver this month was certainly China. In the bottom right there, they came back online quite nicely, up 7.6%. The US, again, just off to the race. Has been an exceptional year for the US so far. S&P up 3.2%, NASDAQ up 3.8%. The DAX, which is Germany, slightly behind at 1.9%. The UK up 2.3%. I was asked to add the ASX, the Australian Stock Exchange, the ASX 200. They're up 2.9%. Russell 1000 up 3.4%. I'll talk to the dispersion in the returns and the other sectors of the US economy coming online in a second. Just for context, again, this is in base currency for the respective index. Moving on, I revert everything back to US dollars. A lot of people like to get their kind of benchmark understanding in USD. Just makes things a bit easier for them. And you can see there again, a fairly similar story. The USD did depreciate a bit throughout July, but not much. On a year-to-date basis, again, in base currency, you can really see there in the red line, the strength of the NASDAQ up close to 45% as at the end of July. Again, on a year-to-date basis, S&P 500 up 20%. Very, very, very strong numbers out of the US. Just talking to what I spoke to last month around the key drivers of that S&P 500 being your large cap tech, and really been a story this year of last year's losers or this year's winners. So nice to see some of that big tech coming back strongly. Again, we saw a bit of a shift throughout the month, which I'll talk to, but still the overall US economy looking quite strong at the moment. Indices in USD, again, we can see China, although they had a really good July, they still largely flat for the year and are lagging other developed markets and EMs quite a bit. DAX also doing well. They had a very tough year last year, and FTSE kind of in between at 13%. Looking at the asset class returns again.
Sorry, Anthony,
yeah.
Can you just take one step back there? Sorry, I'm going to ask the stupid questions, and I'm going to assume I'm not the only one. If we go down the bottom, we've got the S&P 500, that makes sense. We've got the NASDAQ, that makes sense. We've got the S&P ASX, which is Australia. I'm looking down the bottom at your key, basically. Then you've got the FTSE DAX, the Euro. So that's Germany, basically.
Correct.
Then you've got the SSE Composite, which is China.
Yeah, Shanghai.
Okay, so that's 3.6% for the year. Then you got the Russell 1000. What's that?
Russell 1000 is 1,000 mid-cap and small-cap companies in the US.
Okay. And then we've got the FTSE 100, which is England. And then we've got the Hang Seng GR. Which one's that?
The Hang Seng is also China. So China have two main indices. They've got an onshore and an offshore. So it just gives you they're fairly similar. The one is more local Chinese investors, and the other one is more offshore coming into China.
Got you. Okay, great. Thank you.
Brilliant. Cool. So the asset class returns, you can see here in July, MSCI emerging markets was the clear winner there throughout July, largely driven by that strong return from China. On a year-to-date basis, they're still kind of middle of the pack. Most of the rest of the EMs there were kind of doing the heavy lifting. China's, like we saw on that chart, they're lagging quite a bit, which I'll chat to shortly. Commodities came back quite strongly in July again. They were lagging quite a bit on a year-to-date basis. They still are lagging quite a bit, but nice to see some flows coming back into the commodity space again, largely driven by a bit more of a positive sentiment around China. Small caps doing well. That's propelling their year-to-date return up quite nicely. It's a sector that we focused on quite a bit in our earlier market commentaries. May have been a bit early on that call, but it seems to be washing through quite nicely. Then we've got value. Again, also some good returns coming out of the value space. That was the key winner of 2022. But it's nice to see value coming back online again. Developed market equities up 3.4. REITs, global REITs up 3.4. Growth, which has been our clear kind of standout winner on a year-to-date basis, was taking a bit of a backseat throughout the month of July. Still, obviously, massive year-to-date growth throughout the course of the year. And global aggregate, which is your global bond market, up 0.7%. Again, nice to see the bond market coming back online again. We're starting to see some interesting developments there as inflation starts to come down and bond yields remain elevated at around 4.5-5% in the US. You start to get what's called real yield. And real yield is essentially your bond yield minus your inflation rate of that particular country. So you're getting real growth on your asset. So good to see that coming online. That sector is getting a lot more love of late. Okay, then just a brief. I'll stay on this slide whilst I just kind of talk to the key commentary around July and what was moving markets. In the US, we saw a rate hike up 25 basis points. That moves the terminal rate from 5 or to a range of 5.25% to 5.5%, which is high for the US, but hopefully we've seen the peak in the US of interest rates. The next decision will be data dependent. That was the guidance by Jerome Powell at the Federal Reserve. So that's kind of been his guidance throughout the year. It's always data dependent. It's always a wait and see what next month's data is going to tell us. We do have Fed minutes out this afternoon, so I think that will give us a lot more clarity around their thinking at the moment, and whether in fact we've peaked. CPI, our consumer price inflation in the US was probably the major market mover for the month of July. We saw headline inflation fall to 3% from 4%. So quite a big swing there, quite a big drop to the downside. It was more than what analysts were expecting. So that had some really positive, it created positive movements in the market. Core inflation, our kind of a more accurate benchmark of inflation, just as a reminder that excludes food and energy. It was slightly stickier at 4.8%. That actually printed exactly the same as the previous month, which we would have liked to have seen some decreasing there. However, I think there was optimism around the fact that it remained as is and didn't move upwards. So some bright spots starting to show in terms of inflation. GDP in the US was up 2.4% quarter on quarter for quarter two. That was some really positive news. There were concerns that the GDP numbers were going to slow down a bit. Obviously, GDP is quite a quite an indicator or a lead indicator for recession. So those kind of strong positive numbers point to a soft landing, meaning that the US is more than likely going to be able to avoid a recession. That was a word that was thrown around a lot at the beginning of the year. It was almost guaranteed that the US would find itself in a recession, but they seem to be navigating that path really, really well at the moment. So those risks are starting to wash out quite nicely. Again, gives a lot of strength to the market and buoys it quite nicely. In terms of the consumer data, which has always been a point to pay close attention to, because it ultimately speaks to the end consumer and what their financial position is like. The data was still strong. So what that kind of tells us is that these rate increases, whilst they are helping inflation, they're not overly impacting the consumer, which is a good thing. So you don't want to kind of kill off your consumer whilst you're raising interest rates, because that's really what leads to a recession. So the consumer is still looking strong. And that also points to a potentially higher for longer interest rate environment. So if the Fed knows that they can keep interest rates at 5.25% and the consumer is still going to be strong, then they know that they can hold it there for a bit longer, really get that inflation to wash out the system without causing the consumer to struggle. So again, if you look at those kind of numbers, and you look at this asset class return map, so that's largely why the growth style lagged a bit. So growth assets don't traditionally like a high interest rate environment. The reason for that, without getting too technical, is they typically price their cash flows and their discount models into the future. So the higher the interest rate, the more discount they take on their forward cash flows and the more expensive their debt is. So the growth style doesn't enjoy that higher for longer. However, value doesn't mind it. Hence, you saw that kind of shift between styles, between growth and value throughout July. It was something that I alluded to in the previous commentary update. And when we were talking about the big seven and how they had really been the key driver of returns year to date on the S&P 500, I alluded to the point that we will at some stage start to see a shift away from that big seven, away from your more growth orientated names, and into more value orientated stocks. So we started to see that throughout July. It's a good sign. It's definitely not a bad sign. It's good, because when you get widespread return throughout the market and you don't get a concentrated return on a specific few stocks, it points to a much more healthy market, a healthy driver of returns, meaning that everyone is kind of contributing as opposed to a few single names. So it obviously diversifies that risk quite a bit from an index level like the S&P 500, and it really creates an environment where everyone is pulling their own weight. Moving over to Europe, the European Central Bank, the ECB, raised interest rates by 25 basis points throughout July. They're sitting at 3.75%. The tone after the raise by Christine Lagarde was quite dovish. And that really means that they are potentially also nearing the peak of the interest rate hiking cycle. She alluded to the fact that, again, it's data dependent, but she was quite comfortable with the way things were going, the way inflation was coming down. So we may have seen the peak in Europe. Again, fingers crossed for something like that, but just to note that it is data dependent. If we see any wild swings, that could all change. We have seen energy pick up, or oil prices pick up a little bit in the last couple of days, which can be problematic if not managed, but it was a small pickup. It wasn't anything massive. It wasn't like last year where we saw oil at $140 odd a barrel, still around the $80 a barrel mark. Moving to the UK, the UK has always been a little bit of a problem child for us. This year, they also raised rates by 25 basis points. That was at their August meeting was a few days ago, if I'm not mistaken, on Monday, I think. So they've raised rates now. They're currently at 5.25%, which for the UK is incredibly high. They've still got serious inflation issues. I was actually having a look at the data just now. It came out this morning. Their inflation dropped less than expected. So they're still really struggling with high, sticky inflation. So I don't think it's the end of the hiking cycle there. I think we might see a bit more come out of the UK. China also on a year-to-date basis, a bit of a problem child. They cut rates also this week, if I'm not mistaken. They cut rates by a further 15 basis points. It really doesn't seem to be helping. It's quite an anomaly when you think of the rest of the world raising rates and they kind of in this deflationary environment and they're cutting rates and trying to stimulate to the economy. Doesn't seem to be helping much. They're still under quite a bit of pressure. Even though we saw that pick up in July, a lot of that has kind of washed away throughout the course of August. I do have some charts on that I'll get to shortly, but just to keep in mind, China, whilst there could be signs that they're reaching a bottom, there's also signs that they're in a bit of trouble, which I'm going to chat to now.
Sorry, just quickly.
All right. So the first chart on the left
Sorry, Anthony,
yeah.
just before you go there was a question from Rob. Sorry, Rob, I've made it so that everyone can chat to everyone now. Would you mind just going back to that sheet and just explaining the difference between a growth asset and a value asset?
Sure. So on a very high level, growth is considered your more tech-orientated shares. They typically they try and grow their business and create shareholder value by ways of share price appreciation. So they all kind of revenue and profits that they make from their business activities, they typically reinvest that back into the business and back into new opportunities because they're of the belief that they can generate far higher returns on that capital versus paying it out as a dividend to shareholders. So they're quite aggressive on their growth strategy in terms of reinvesting revenue and profits. Value is somewhat the opposite. They focused on paying out revenue or profits to shareholders in the form of a dividend. They've typically reached the end of their growth phase. They're not looking to aggressively reinvest into new projects and things like that. So that's kind of the key difference between the two values. Also considered if a share is trading at a lower price relative to what their fair value is deemed, they can sometimes fall under the value category. But it's typically what they use their free cash flow to do, what they do with it. Does that make sense?
Yep, thank you. I mean, in simple terms,
Cool.
and again, tell me if I'm wrong, but a growth stock is Meta, as in Facebook or Amazon, or Alpha, which is Google, and the value stock is, I don't know, Unilever or what's a
Coca-Cola,
something like that,
Spot on. So do yourself a favor and go look at the dividend yield of Meta or Alphabet or things like that. You'll struggle to get 1-2% out of those guys, if anything. So they make it very clear that they believe that they can reinvest their free cash flow better than a dividend yield of 4-5%. They can compound that at a much higher rate, and that shows itself in the share price appreciation, and that's how you derive your value from it.
Perfect.
Cool. Okay. So just back to China. The first chart on the left is China's inflation, their CPI, and you can see there that it's trending sharply down. So they're facing some serious deflationary pressures, which again is a complete anomaly when looking at the rest of the world who's trying to rein in their inflation because it's gone too high. China's got the opposite effect. Now, when this starts to happen, they fall into a balance sheet recession, which is ultimately a situation where the private sector or the consumer is deleveraging. So they're looking to pay off bonds on their houses, pay off their cars, pay off credit cards, things like that. They're not taking on more debt. So when I spoke about the fact that China had cut their interest rates by 15 basis points in the last few days, it's powerless. So monetary policy kind of completely falls out the window in a situation like this, because no matter how much you cut your interest rates, if your consumer or your private sector is not making use of debt, you're not stimulating the economy. So just for basic kind of economics 101 is typically guys will cut their interest rates, or the countries will cut their interest rates when they want their consumer, you and I, to spend more, take more debt, borrow, buy houses, buy cars, buy things like that, and just prop up the economy. But when the consumer doesn't do that, it becomes quite a blunt tool. So China's facing that at the moment, which is quite a concern. They're a big economy. They typically generate they're a big contributor to world GDP. If you're a South African, they're heavily reliant on commodities that come out of SA. So it creates a little bit of trouble amongst the emerging markets, in particular, as well as global markets. So that's something we're watching quite closely. It will be interesting to see the Chinese policymakers and the big government officials are on their annual retreat at the moment, and they typically come back from that with quite a bunch of new policy updates and new plans and things like that. So we'll see if anything positive comes out of that, which I'm assuming it will. But it's an economy to keep an eye on. If we go to the top right, the first number of the week there, it contradicts what I'm saying, but it also helps create an investment thesis around China potentially being very, very, very close to their bottom, if not at their bottom. So the number of the week is 16%, and that's really the tourism number. So the domestic trips that the Chinese people are taking within the country have increased by 16%, which is good to see, because again, that's that kind of activity that you want to see within an economy to kind of prop up the numbers. You want to see guys getting out of their houses, going on holiday, spending money, being active, traveling, spending money on flights. That's all positive. So what China's trying to do, and what their problem is getting their consumers to spend money. I think they've been so shell-shocked by what's happened over the last year, 2 years, with regards to COVID and lockdown and things like that, that they're actually just they're almost petrified to spend money and leverage themselves again, because they're very uncertain around their kind of outcome. So that's a good number to see. So hopefully that picks up a bit more. We start to see a lot more activity on the ground in China, and that helps boost some of their metrics. Okay, moving away from China and just ending off again with the US. I've got another number of the week there, which is quite an interesting one of 12%. And really that's saying that historically, after the S&P has had a 5-month consecutive rise, so month-on-month increases in the S&P 500, the following 12 months have typically generated a return in excess of 12%. So that kind of bodes well for the situation that we're in. The S&P has done that successfully throughout January to end of May. We've seen a bit of volatility this month, which is interesting, and actually it was expected, and it was wanted, in the sense that if you kind of just cast your mind back to the year-to-date numbers, we've seen the major US indices run extremely hard. So it was inevitable that at some point there would be some profit taking, there would be some repositioning. And really what that's done now is it started to create some attractive entry points. So if you're looking to go long equity and you want to buy equity for the future, you missed the kind of year-to-date rally that we've seen so far. These are becoming quite attractive entry points to get some long-term exposure. Dropping down to the chart below that. So what that shows is it looks like a very confusing chart, but it's really just the implied probabilities of interest rate hikes. And this is looking at September, which is the next hike or potential hike or the next policy meeting. And basically what you can see there on the far right of the chart is that the market is anticipating no change to the interest rate. So in other words, a hold, not raising rates, not cutting rates. But really that this chart kind of backs up everything I've been saying around the US potentially being at its peak at the moment. Obviously, we're going to take a lot of guidance and a lot of understanding from what they say this evening. But ultimately, they should stick to this kind of consensus. Lastly, just some interesting reading I was doing at the beginning of the week. We've seen in the US a lot of the hedge funds and institutional investors, so your big banks and things like that, they've been using this recent dip throughout the beginning of this week to load up on more tech and any AI related businesses. So again, if you're a fan of following the big institutional guys and the hedge funds, you could potentially be looking for entry points in some of the big tech names, as well as some of the guys that have kind of AI or are AI centric. So have some kind of underlying link to artificial intelligence. That's been a major theme this year, but it looks set to continue. Yeah, that's me.
Awesome. Thank you very much. Appreciate it a lot, Anthony. In terms of it, as always, thanks. If you can just share that with me. I know you normally do, if you probably have already. And then I'll just put it in the WhatsApp group for everyone. And Alex had a good idea as well, which we will aim to create a little cheat sheet around those key metrics, just so people can take a look at it going forward. So thanks for the questions. Any other questions? I know we're sort of on time, but any questions or any thoughts that anyone's got, either put your hand up and talk or just put it in the chat box. I see that Cynthia is going to sort out problems for China by raising her prices, so they can come on holiday to Italy and spend more money. Anything else from anyone? Nope. Okay, cool. Anthony, wonderful, dude. Thanks so much for the update. As always, I learn a huge amount. So thanks so much. I really appreciate the update in terms of the process.
Excellent. Pleasure, Scott. Cheers, guys.